Good, get started. Hello. How's everyone doing? Today we're talking about institutional lending in DeFi. And I have these amazing guests on my left with Sid Powell, the founder of Maple Finance. And we have Drew Vanderwerf, an investor at Brevin Howard, who is also one of the first members of Goldman's digital assets team. And my name is Amy. I am the founder of Background Network. I'm also local to Austin. And just get started, I'd love to just hear from our panelists just a little bit more about yourselves, maybe even how you got into DeFi and crypto, and a little bit more about what you're working on right now.
Awesome. Good to see you guys. I just moved to Austin, so if there's anyone here looking to get a beer, I'm down. But yeah, I started into crypto, went to a random meetup. One of the founders of the chain was there back in 2015. I was there for free beer and pizza, but found the energy, just too eccentric. I had to jump down the rabbit hole. Joined Goldman Sachs digital assets team, which probably not many people knew about. We were nothing for a while, and then everything blew up, and it grew a ton. And so there was a lot going on there that they don't talk about. But left there and joined Brevin Howard, which is a fund in the space and has been a long-time macro fund.
Hey guys, I'm Sid. I'm the co-founder of Maple Finance. So for those who don't know us, we are a DeFi lending protocol. So how we differ from other lending protocols is that there's more of a focus on under-collateralized loans. So it's actual credit creation. It's targeting corporate and institutional borrowers. We've been around. We went live in May of 2021. So we've done about 975 million in loans so far. Team's about 30 people. But I came myself from a TradFi background. So I used to do banking, and then I was running the treasury at a fintech back in Australia. And so got into the space first back in mid-2018, and then wrote the white paper on Maple in early 2019, and just building since then.
So backstage, we were talking a little bit about how the ecosystem has changed since 2018 and 2019. I'd love to hear it from your vantage point of like how has the way that institutions think about DeFi evolved in the last couple of years, and today, how do you think about DeFi opportunities relative to traditional sources of yield?
Yeah, so I'll start with kind of my experience when I was at Goldman. It was funny because we started the team back in 2018. I had 2 calls with clients. Literally no one cared. And then over the last year, there were 1,000. And it's interesting because it started with people asking what is Bitcoin? It was the classic education session. And then they started to say, how do I buy Bitcoin? And they come back a couple weeks later, they're like, what's this Ethereum thing? What you can actually use this stuff? And they come back and they start getting to the DJing questions, how do I yield farm? How do I do this? So it was super interesting to see that there's this 2.5-year hockey stick curve just for people to buy Bitcoin, and then about a month or month and a half gap where people actually understand that technology can have use. And so I still think we're super early days. There's still a lot of problems, mostly on the education side, in my view, that some trader or someone in a large institution says we should be doing something in DeFi, and they go talk to their lawyer, and it's that 2-year journey again to get the lawyer up to speed and everyone on board. And so, I still think we're really early days, and things like Maple and what a lot of people are building out there today, are the foundation of that. And the other interesting thing that could be, help this develop is, cryptocurrency is great. I love it. Down the rabbit hole, live and breathe it. But as soon as you start bringing real world assets on chain and leveraging what everyone's building, it becomes much more interesting. One of the banks out there actually used a bond on chain in the MakerDAO protocol, or at least proposed it to borrow against it. So those types of things become quite interesting to large institutions that are holding these assets, familiar with the assets, and just using technology in a more, an efficient way to get broader access, to have more automated and cooler products come to market.
Yeah, I just echo what Drew said. So I think a lot of institutional participation began by looking at crypto as just a volatile asset they could hold for longer term exposure. I think what we've seen, and that would have correlated about 2 years ago with people saying, okay, DeFi is a scam, even up to sort of early to mid last year. And then what we've seen since then is you then had DeFi summer kicked off and you had eye-popping yields. So then there was a lot of interest from institutions, but kind of still looking at this as a bit, of a questionable space. But I think what the eye-popping yields of DeFi summer did was they brought interest and talent into the space, and then it kind of birthed these products that now institutions are looking at as kind of something viable that they could actually run projects on. And so you're starting to get internal interest at these larger companies, be they from Web 2 tech or from TradFi, in running pilot projects where they would actually use DeFi as infrastructure. And so I think that's probably been the main shift, is rather than DeFi as something for speculation, it's now like, okay, this is an emerging set of infrastructure that we can run financial products on, and potentially kind of become an emerging player in this space. So for Maple, the pitch is you can run a lending business much easier and in a much more scalable way than you could if you were starting a lending business from scratch by using the blockchain. DeFi is just the application of software to the transfer of money, effectively.
That's fascinating. And I guess on that point, like, how do you think these institutions actually have to change and evolve in order to run their infrastructure on the blockchain? Like team composition, the in-house technology, what are the ways that you're seeing like traditional institutions evolve in order to embrace this new technology?
Yeah, definitely talent is a huge issue. I mean, no one that's really good at DeFi wants to work at a bank, just to get started there. And particularly developers, which you need a lot of, because they have all these systems they use and they need to connect them in some way to the chain. They need to, there's just all these problems. And so, yeah, team composition. But to give you a sense, our team grew from a couple people to over 40 in a year. And so like, large institutions are starting to scenario plan, like, what if this technology takes over all the operational processes we have as a firm? And if you think about big banks, that's their moat, is they have economies of scale. They're able to process a lot of information at one point in time and risk manage that. And so if you start to take that internal infrastructure and anyone can access it at any point in time, your business model starts to look very different. Will they go away? I don't know. Do you want to call up someone you can trust to manage your risk? Maybe. And that's why there's these hybrids out here like Maple and a few others. And I don't, we're not attached to Maple in any way. I just think it's an interesting project of this hybrid between the old world and the new world. And again, using technology in a more efficient way to create different products and provide economies of scale, basically, that's shared amongst the whole ecosystem and world, rather than just a single institution that's an intermediary taking its take.
Yeah, I think it is an interesting point. Like, how much can existing institutions who are large players or incumbents already in TradFi or Web 2 make the leap to being dominant or at least competitive in Web 3? We haven't really seen it a lot in other sort of phase shifts, whether it was moving from rail to automobiles or from conventional cars to electric cars. You don't tend to see the incumbents be really successful, and certainly not in a short frame of time. What you do tend to see is that the talented teams who are kind of proposing or endorsing these projects internally tend to just spin off and do their own thing, and they are usually the creators of other successful startups. So in Maple's case, we're providing a lending product or infrastructure to go and run a lending business and do that on chain. So lending business, fixed income asset management. So we would be talking to large TradFi players and investment banks. But what we might find is that it's actually the nimble, agile teams who are already part of these organizations might just leave and form their own businesses and kind of use Maple in the same way that you might have had a big box retailer, and it's just a team that spins off from that and goes and starts selling mattresses online and really pioneers, the e-commerce space. So I tend to think that's probably how it will go. But I think over the longer term horizon, you'll start to see more buy-in from larger companies, be it JP Morgan or someone else or Goldman's, in running these projects and actually devoting more resources to it. But it's probably like a 10 to 15-year horizon for them.
That's fascinating. And actually, as someone who has in the past also worked at an institution, I'm very excited for a new generation of money managers, especially fueled by crypto coming in and taking the lead. So we mentioned education, we mentioned the tooling and talent. Like, what do you think are the other big bottlenecks to like widespread institutional adoption of DeFi and lending?
Yeah, in my mind, two things: regulatory clarity, but I'm not going to go down that rabbit hole because that's all we hear about these days. The other thing, again, is just different types of assets on the rails. So again, crypto, I love it; it's great. But if you could start to, create standards and then digitize or tokenize things like real estate, which we've been talking about for a long time, private markets, it becomes very interesting to institutions. And even the carbon market, it's very inefficient. tons of risk because intermediaries, it actually does a lot for the environment. Those are certain use cases that, institutions can get on board for because they understand the asset. It's just a new rail to transact in. And so once you get it into those rails, you can start using everything that everyone's building. And it becomes much more of an incentive for large institutions to do the work, to get comfortable, and then start executing using these technologies.
I think two things jump out the most. Probably the first one's custody. So a lot of large institutions are actually not even permitted to hold crypto on their balance sheet. So that's obviously a massive roadblock if you want to participate in DeFi, and it pushes them into using large custodians. So that's why you're seeing a lot of large custodians do pretty significant fundraisers at the moment. So that would be element one. I think interesting products that are kind of reversing this trend are things like Fireblocks, Fireblocks and Copper, where you have the ability for institutions to self-custody and impose the kind of policies that effectively just custodians would run ordinarily. I think that's an interesting product disruption there. The other one would be on-ramps. So if you want to go and participate in scale in DeFi and put like 10 million in, it's not easy to just get a hold of 10 million in stablecoins or get from fiat 10 million of fiat into 10 million of USDC or Tether. So I think easier on-ramps, and this would also be, getting towards user experience would be a really important one. If we want to go and win business in like the order of $100 million from, a really large family office, their first question is going to be, how do we actually participate and deposit into the protocol? And so then you go down the path of saying, okay, well, you've got to set up like a Circle account or something else. So I think ease of on-ramps is probably the other major element.
Related to that, do you think DeFi today has enough market depth in order to handle like the widespread adoption from institutions like these $100 million family offices, like larger like pension funds, things like that? And like, where do you think the gaps are?
It's a good question. I don't want to insult anyone. No, it still has a ways to go, right? Like you're still having hacks. You're still having people send money into the abyss because they're not educated on how to like control those things. Just even understanding the real risk of DeFi, there still isn't an ability to do that. To stress test the liquidity in some pair in Aave, whatever, during a stress scenario. Those tools are developing, but they're not there. Or understanding, the cross collateralization that's taking place and the systemic risk that happens if there's a liquidity event. These are the types of things, because they're traditional risk managers, they start to think about. And the tools just aren't there yet for that, and it's very difficult to do. That's probably why. I mean, great business idea. If someone wants to do it, love to see the pitch. But it's these types of things that still need to come along and be developed for institutions to really get comfortable to do it in broad scale. Now, small projects learn, sure, it's good stuff, and there's a lot of things that have been battle tested and survived crypto winter and done pretty well. So,
yeah, I think market depth outside of the main coins, probably not there as much. But if you look at the market cap of stablecoins, it's starting to get there where institutions can participate in size. Like, we've got 750 million in TVL at the moment. So in terms of access to stablecoins that you need to participate, I think that's there. But then it would be, if you need to trade through different pairs, I think the liquidity is probably not there. Certainly not through DEXs. Like when we look at what cryptocurrency we might use as collateral, if we were to partially take collateral against a loan, it's really only like WBTC and wrapped ETH that would kind of provide the actual depth that you'd need if you needed to do a liquidation.
Yeah, and even on that too, if institutions could own crypto, there's still so many limited ways to hedge out your risk. Yeah. So like you have offshore exchanges, a lot of like institutional clients can't face them as a counterparty. And so like there's these other issues too, that you can only have so much capacity because you can only hedge out so much of your risk, given a position. So some other dynamics too.
Probably dollar settled instruments would be pretty important as well. Like they can't really take delivery in cryptocurrency for a lot of them. So
that makes sense. And are there certain use cases that you think institutions, or the clients that you're seeing, or at the institutions you've worked at, that are particularly exciting? Like I know at this conference we've talked about flash loans and either providing liquidity for AMMs, like things like that. Like what are the ones that stand out that institutions are particularly interested in?
Yeah, I think the biggest thing is what are their businesses that are going to be relevant? Again, if you take away the operational efficiencies these big firms provide, there are certain things they're actually really good at, and they should get paid to do. Those are the things where they see opportunity, and where they can be a toll gate, they'll continue to push towards that. A good example is risk management. Again, these large firms, depending on your views, they're pretty good at managing risk, or they hire people that are good at that. You may want them doing that as sort of like a pool in Maple or whatever it may be. And so businesses like that, they're super interested in. Other areas, that they're sort of like cost centers. They could actually change into revenue generation. So that may be, they KYC AML all their clients. Every firm does that. What if they could do that and then charge someone every time they used that stamp of approval that this person, is KYC and AML'd, things like that, where they could generate revenue on something that currently is is basically a cost center and dragging down revenue. So there's certain things like that could be interesting to them.
Yeah, I think that is an interesting idea of turning kind of cost centers into products. I've seen a few tokenized KYC projects over the last few months, and I think if you could have composability of that service, then it effectively takes something that you pay for internally or you hire a team to do, and turns that into something that you just pay another project to do. So I think that's pretty cool.
And where do you see DeFi lending going in the next 12 months? Well, first, where do you think it is today? What's the kind of state of the world, and what are you excited about in the upcoming year?
So it's probably better for this one, but it's come a long way, right? We were joking before. I don't know if people remember Oasis with Maker, and the website would shut down when you had to submit transaction 4 times. It was not that great, but so we've come a long way. And you got these projects with $1 billion and value locked and things like that. So I will say that still a long way to go for institutions, but it's definitely a first use case they can grasp without having to understand all the technical details of flash loans, all these things. And so, getting real world assets on chain and being able to lend against those, could be fascinating. And I expect this year, hopefully, we'll see an institution do that at some point in time. That's $1 trillion balance sheet or something like that, get involved in one of these things.
Yeah, I think to shill us, the milestones we'll be trying to hit will be 5 billion by the end of the year. But to what Drew said, I think if we can start to bring on other industries, and some of those industries might be real world assets. So, for example, financing miners could be pretty interesting. These are all opportunities that exist because TradFi hasn't really embraced the other uses of crypto outside of just holding Bitcoin and the larger cap ones on their balance sheet. So I'd say, the kind of milestones you'll see will probably be lending to industries outside of the core market makers, which are the dominant borrowers today, both from DeFi platforms like us and from centralized lenders like Genesis and Celsius and BlockFi. And then the other one would be whether we see any publicly listed companies or really large companies that are quite well known sort of participating in this. Like SocGen did the debt through Maker. So I think you might see some publicly listed miners or other publicly listed companies start to look and consider DeFi as a source of borrowing. Just a better relationship to have than your bank.
That makes a lot of sense. And so you mentioned sort of centralized players versus decentralized players. How do you as more institutions get involved, how do you think about the trade-offs between working with a more centralized protocol or company or I guess company versus a decentralized protocol?
Definitely for Sid.
Well, how we position ourselves is more as infrastructure, which either centralized lenders could use or new native, say DeFi lending businesses could use. But we're just the layer of infrastructure, kind of like Shopify, in that Shopify provided out-of-the-box tooling, which you could use if you're an e-commerce company to go and start, selling internationally, and you compete on price, selection, what have you. We provide the same sort of tooling where you can compete on risk management, ability to source capital. And so you could see either a new team that might have spun off or spun out of, say, PIMCO or Fortress Group, or it could be a native CeFi lender like Genesis or like BlockFi or like Celsius. Celsius just set up a pool a few weeks back on us, so super excited by that.
Amazing. And I guess now I want to open up to the audience to see if anyone has any questions. If not, we can continue the conversation.
Yes. Yeah, I think it could spill over to consumers eventually. The way that we might be involved, though, would be, say, lending to a company that has really good expertise at credit scoring or underwriting retail borrowers. and therefore we would continue to lend to an institution, but that institution is then doing, $5,000, $10,000 loans to to retail customers because they have the ability to assess them in a really scalable way, and they've developed, let's say, like an algorithm that could score on-chain activity. So I think what's required there would be good on-chain credit scoring. So I think there's a couple of projects doing this. There's like Teller, there's Spectral Finance, there's Credmark here out of Austin. And so I think that's probably the most salient thing that's needed for that market to open up.
And how do you do it with institutions today, the under collateralized loans?
So once you onboard an institution, so you KYC them so that you know who you're dealing with. But then the real nitty gritty is sort of meeting management. You assess them, you look at their financials. So generally you get updated financials on like a monthly basis. And it would look fairly similar to what you would do if you were lending to them as a bank. You're making sure that they have enough money or that they earn enough money on a recurring basis to pay back the loan and that they're not, levered to the hilt already.
Any other questions from the audience?
At the very back.
Cassie.
We do, but I would say probably 80% of their business is actually taking place on centralized exchanges. So you'd miss the bulk of the trading activity. Like let's say you're dealing with a large market maker like an Alameda or a Wintermute. Most of that activities, like they'll still trade on DEXs, but most of it is actually happening on Binance and FTX. As it shifts more, I think you'll be able to, though. Yeah, sorry.
What's the state of insurance? You touched on risk management a little bit, but I guess insurance is part of that. Question. What kind of, where are we and what are the bottlenecks of what's holding us back, I guess?
Yeah. No, that's a good question. So I'd say insurance is probably too capital inefficient at the moment in that relative to the amount of protection you get if you're doing, say, under collateralized lending like us, the price point is probably too high. So it erodes the sustainability of the business and what you can pass through to the lending capital on the other side. So what's required there? I think obviously like sharper pricing and kind of capital efficiency. But the type of insurance that we're more concerned about is actually credit protection or credit default swaps. Because the main risk for someone depositing into our platform is probably more the default of the borrower rather than a hack in particular. If you're going on an over collateralized lending problem, you're probably more at risk of a hack because you have continuous rebalancing of asset prices, you have multiple assets in the pool. But I think there are a few interesting insurance projects. There's like Sherlock, obviously Nexus is sort of the 500-pound gorilla in the room. And so I think as we see more events happen, they will get better at resolving those. Currently, it's very sort of overly prescribed how you would actually get a payout from those platforms.
From an institutional perspective too, there are insurance policies out there with the major exchanges from a custody perspective, but just like a simple thing, they're not even denominated in crypto. So if you have a $100 million policy, but Bitcoin rips again to 65, you still have a $100 million policy. So in my view, there's still like a growing portion that needs to happen on the institutional side for them to just like start denominating things in crypto and then also start to understand protocol risk and ensure that. And in my view, once they get there, just my own personal view, then they can start using the Nexus, the Sherlock. And again, it's just making a better scalable business than what they have today, which is siloed, unshared operational processes and things like that. So when they can come into it, it'll get much bigger.
I think that's all. Thanks, guys. You've been great.
Yeah, thank you so much. Thank you.